The OPEC cut agreement that OPEC came to in December is not really working as it was intended. On Wednesday, we saw another big increase in U.S. Crude stocks, up 9.5 million barrels to about 518 million barrels total, and that's several weeks of increases in crude stocks. In addition, the other big thing to watch today, there are two things actually. One is the Baker Hughes rig counts come out again today. Last week, the rig count was up 17 rigs, a huge record over last year. We've seen again several weeks of increases in the rig counts. The other big thing is the OPEC compliance report for non-OPEC. So most of this week and last week, we heard lots of boasts from OPEC producers about record compliance under the agreement. 90% was the number thrown around. If you actually add in the countries that were exempt from the agreement, Iran, Nigeria, and Libya, that compliance number is really 75%. It's good, but it's not great. And if OPEC wants to achieve its stated goal of drawing down global crude stocks, it really needs to have 100% compliance, not just from itself, but also from non-OPEC members. And that information is reported to a monitoring committee on the 17th day of every month. So that's today, February 17th. We still haven't seen any kind of public report posted by OPEC, but we have some indication just based on what other countries are saying they're doing. The big one, of course, is Russia, which committed to about 300,000 barrels a day in cuts. It was the reason why the agreement was possible, why the Saudis agreed to do it, because the Russians said that they would do it. And Russia has reported for January only about 100,000 barrel a day cut, so a third of what they're supposed to be doing. So it's hard to see how the non-OPEC producers can get above 50% compliance. So in order for these global crude stocks to start declining, which was OPEC's stated goal, and I think the reason why you see a lot of longs in the oil trade right now is that they expect in the second half of 2017 for these crude stocks to start declining. But in order to do that, they need 100% compliance from OPEC, and they also need U.S. shale to behave. And we've seen U.S. production start rising. It'll probably be above 9 billion barrels a day soon. These rig count increases each week. There's another indication that U.S. shale and U.S. production is kind of responding to higher price signals as a result of the agreement. The other big question out there that we just don't know the answer to is, will OPEC extend the 6-month OPEC cut agreement? It expires in June. When they announced it, the market really priced in an automatic extension of the cuts. The Saudis about 2 weeks ago indicated that perhaps they may not need to extend it because, in their opinion, the agreement and the cuts were working as intended. I think that message sort of startled people because, I think the Saudis' message was aimed at two audiences. One, OPEC and non-OPEC members, to sort of incentivize them to start getting compliance under the agreement. And two, also to U.S. shale, to kind of, be a little alarm bell that maybe higher prices might not be here for too long, so don't make a lot of investment decisions and start cranking up production. However, U.S. shale has shown no hesitance in responding to higher prices, and so we're starting to see U.S. production rise. So I really think it's an open question now whether OPEC will extend the agreement. I think largely depends a lot on continued compliance and also on what shale does, and we're just going to have to wait and see. But if OPEC wants to start draining crude stocks, global crude stocks, in the second half of this year, they really do need to extend the agreement. So we're just going to have to wait and see what happens, but I think it's very much up in the air right now.